The problem is that once the equity bubble pops, then QE, you're going to see so much QE because basically the Fed will have to support the entire economy, including the financial economy, by buying it effectively, underwriting it. And this is going to mean QE big time. Yeah. And that's debasement of the currency, quite simply. The Chinese feel they've got to protect the yuan from a collapsing Western financial system. And that collapsing financial system, I think, is probably tied up very much with the equity bubble in America, the credit bubble, in effect. When that goes pop, then the whole system is going to be destabilized. And that, I think, is going to be the big story in the first half of 2026. And it will kill the dollar as well. And you saw gold, double, triple, quadruple from there.
The global financial system is moving closer to a breaking point, and the warning signs are no longer subtle. Equity markets are stretched, debt levels are extreme, and confidence is holding together on borrowed time. When the bubble finally breaks, the response will be fast, aggressive, and inflationary. Alasdair Macleod, a veteran analyst of monetary history and currency risk, explains why the next phase could be decisive. Once equity markets roll over, the Federal Reserve will be forced into massive quantitative easing to support not just banks, but the entire financial economy. That scale of QE is pure currency debasement. At the same time, China is already preparing for a collapsing Western system by protecting the yuan and reducing exposure to dollar risk. Macleod argues this crisis is likely to dominate the first half of 2026, and when it hits, the dollar will weaken sharply. Historically, that is when gold revalues violently, doubling, tripling, even quadrupling as trust in fiat erodes. Now, we present the clips from Alasdair Macleod's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
Basically, China has been controlling the silver price for the last 3 decades. It started with the rare earths. It decided, you ain't getting rare earths. And when the silver price started rising, I think China realized that it had to make a choice. Do we continue to suppress the price at the risk that we lose our strategic stocks because they built up strategic stocks? I mean, bear in mind that China is the second largest silver miner, and also it is the largest processor of both silver, doré, and also metallic ores, copper, zinc, lead, and all the rest of it, where you find silver. So they have accumulated huge quantities of silver. They have been the swing factor in the price. That is absolutely clear if you actually look at the facts. So what she's done, basically, is she's decided to not completely remove supplies into the West, but to control them more closely. And this was really behind the new licensing regime, which applies from this January and is due to be in place for the next 2 years. If you look at base metals priced in gold, which is money, and over long periods of time is relatively constant in its purchasing power, you can see that these base metals are extremely cheap. I calculate a basket put together by the IMF to be around about 18% where they were, if you like, up until Bretton Woods was abandoned. 18%. What that tells us is that in real terms, in other words, priced in gold, they're going to rise 4 or 5 times before they are overbought. Now, if at the same time the purchasing power of the dollar is going down, you can see that over the next year or two, the dollar price of this basket, and it includes copper, is going to be quite a bit more than that. I mean, you could easily see it 10 times as much. That is the consequence of a collapsing purchasing power of the dollar. And of course, there are knock-on ramifications for that because you're going to get higher consumer prices. I mean, wholesale prices, obviously, then consumer prices. And that does mean that you're going to get higher bond yields. And higher bond yields will pop the equity bubble. So, this is a situation where I think both the dollar and the US is in an extremely fragile position. The problem is that once the equity bubble pops, then QE, you're going to see so much QE because basically the Fed will have to support the entire economy, including the financial economy, by buying it effectively, underwriting it. And this is going to mean QE big time. Yeah. And that's debasement of the currency, quite simply. China does not want to be blamed for destabilizing the global financial system. There is nothing. There's absolutely no point in her doing that. What she will do, however, is she will take steps to protect the position of her own currency. Of that, I'm absolutely certain. And you referred to the April 2nd day when Trump was banging off with all his boards about tariff rates for X, Y, and Z, and all the rest of it. I mean, in the wake of that, President Xi did two things. They announced an acceleration of the free trade agreement, a move towards the free trade agreement between China, South Korea, and China. Now, okay, there's been a change of government, if you like, in Japan. But the other thing he did was a whistle-stop tour around Southeast Asia. And that was followed not long after by an announcement from the Shanghai Gold Exchange that they were opening a vault in Hong Kong and also in, guess where, Saudi Arabia. So, this is clearly preparation for an exchange rate to be fixed between the yuan and gold at the time when it is appropriate to do so. And that time, in my view, and this is, you don't have to be the brain of anywhere to work this one out, is bound to be when the Chinese feel they've got to protect the yuan from a collapsing Western financial system. And that collapsing financial system, I think, is probably tied up very much with the equity bubble in America, the credit bubble, in effect. When that goes pop, then the whole system is going to be destabilized. And that, I think, is going to be the big story in the first half of 2026. And it will kill the dollar as well. I mean, from that point, the dollar's really going to go down.
China has quietly been the swing factor in the silver market for decades, using its position as a major miner and the world's largest processor of silver-bearing ores to manage supply flows into the West. That strategy is now changing. Instead of entirely suppressing prices, supply is being tightly controlled through a new export licensing regime that runs for the next 2 years. At the same time, base metals priced in gold remain historically cheap, implying a powerful repricing ahead. As the dollar's purchasing power erodes, the nominal prices of silver, copper, and related commodities could rise by multiples, feeding into higher wholesale and consumer prices. Rising inflation pressures will push bond yields up, threaten equities, and force aggressive QE. The result is a fragile dollar, a destabilized credit system, and a rapid shift in global monetary power. Let's get back to the interview.
Looking at gold is the wrong thing. Look at the purchasing power of the dollar. As that collapses, obviously the price of everything rises. Now, we're going to have in this year, I mean, there is going to be no doubt at all, we're going to have higher consumer prices this year, and they will be significantly higher. Nobody's expecting this, but it's the only outcome that makes any sense whatsoever. So as they go higher, what you will get is the political response. Everybody knows that the most stupid thing you can do, is to introduce price controls. But what will happen? The easiest thing to forecast is price controls. Why? Because politically, they will be seen to be necessary, even by people in politics who understand how counterproductive price controls are. That's the way that this is going, and it will just collapse the purchasing power of the dollar even further. I mean, this is a situation which is just post-Bretton Woods, end of the fiat currency system. And when you end the fiat currency system, unless you tie the fiat currency to gold, it goes down to zero. And I think this is a 2-year process maximum. It could even be a year to 18 months. I don't know. We have to see how quickly it happens. And you can see with the Chinese moves basically to take the whole of the BRICS and the Shanghai Cooperation Organization away from the dollar, introducing, I mean, all this stuff about unit and all the rest of it is actually hogwash. What they're doing is quite simple. They're doing a Bretton Woods Mark III, and that is a currency system which is based on a yuan, which for trade settlement purposes will be tied to the value of the dollar. I don't see the Chinese public being allowed to exchange their yuan for gold. Sorry, tied gold, I should say. I don't see them being able to exchange their yuan for gold. But at the international trade level, countries will be swapping yuan for gold and gold for yuan. That's the whole point. The only thing we don't know at this stage is what the fixed rate will be, and there will be a fixed rate. That way, the yuan for international trade purposes becomes a gold substitute. They won't need to hold gold, they can hold yuan. And that's basically where it is going. And the dollar will be out of it completely. I mean, if the dollar can't even try to go back on a gold standard because there is huge doubt over the gold reserves of the US Treasury. We know, for example, that a lot of gold disappeared into the market when they tried to rig the market in the 70s to drive gold out of the system. We know that there was a massive carry trade out of bullion, lease bullion. Your leasing costs were 0.5%, 1% tops. And at the time, you could sell it into the market and apply the dollar proceeds to US treasuries, which were yielding anything from 10% down to 5%, from the early 1980s onwards. So where did that go? Well, an analyst called Frank Veneroso reckoned that it all went into the market, never to be seen again. He thought it was probably adorning the necks of Asian women, which I think was a slightly flippant remark, but it was something that made the point. I reckon that China was in there picking it up because it was really from 1983 onwards, China basically embarked on a program of secretly buying gold. And, they had a wonderful bear market to do it. And when did the states suddenly decide that they could let its own citizens in on the act? That was at the bottom of the market in 2002. And the Shanghai Gold Exchange was then opened. And since then, the general public have taken delivery of something like 28,000 tons of gold. And that's in addition to anything which Chinese government acquired. We're not talking about the People's Bank's reserves at all. That's a completely different thing. But what they acquired, I reckon they could easily have acquired between 20 and 25,000 tons by 2002. And they have continued to acquire gold since then. I think at a lesser pace, admittedly. But they've got ample reserves. And a lot of those reserves would have come out of Fort Knox, in effect, as a result of America's attempts to drive gold out of the system and replace it with the dollar. By putting the yuan onto a gold standard for international trade, then you're looking at the Industrial Revolution really taking off in all the BRICS and Shanghai Cooperation Organization memberships, and the whole of the global South who wants to join in on this. Yeah, you've got India is developing very rapidly. And incidentally, I would say that just looking at GDP actually doesn't tell the whole story at all. All that is a measure of the amount of credit being deployed in the economy, not how it is being deployed. But India is really taking off now. And of course, this is one of the things that has led to the silver price rising, because China realizes that, India's demand for silver, because it gets into photovoltaics and all the rest of it, is just going off the charts, because India is where China was 30 years ago. There is massive, massive development to occur there. And you've got, the whole of the rest of the world is sort of, one step behind India. Africa, where I'm going at the end of this week, that again has been growing quite rapidly from a very, very low base. But the industrialization of Africa is I think, over the next 10 years, going to be something to behold. So we're seeing an industrial revolution, not just for the elite developed economies, the G7 economies. We're seeing it for for the emerging nations, the 70% of the population which hasn't enjoyed it yet. This is massive. This is absolutely massive. And we don't have a part in it. And we don't even understand that, the implications. This is something that I think even Trump is trying to stop. The whole situation is one for a dollar collapse. And, I think people who think that inflation is a mathematical process have got this entirely wrong. Because firstly, the foreigners will lose faith in it, and that will drive it down. And as the foreigners lose faith in it, you will find that US institutions start losing faith in it. And the last people to lose faith in it, of course, will be the general public in America. And they will then learn the hard way. Once the dollar's lost another 99% of its purchasing power or more, they will then learn that it's not prices going up, but it's their dollar going down. And at that point, they'll start dumping it. And then it's finished. Game over.
The real issue is not the price of gold itself, but the steady collapse in the purchasing power of the dollar. As inflation accelerates, consumer prices rise, and political pressure leads to destructive policies like price controls. The fiat system weakens even faster. This is a classic late-cycle dynamic seen after Bretton Woods, where currencies lose credibility unless anchored to something real. What follows is a loss of confidence, not just domestically, but globally. At the same time, global trade is quietly shifting toward a new framework where gold-linked settlement replaces dollar dominance. Industrial growth across Asia, India, and the global south is accelerating this transition, driving demand for hard assets and exposing the fragility of paper money. This is not a distant theory, but a structural reset already in motion. Share your thoughts on his analysis in the comments section below. If you find this video informative, please support and turn on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.